Hey guys, Nick with Mission FX here. Um, Lately, more and more, I've been coming to the realization that trading Forex, for me at least, is just really about staying peaceful and watching the market, but not too much, taking trades, but not too many, managing positions, but not too often. And trading is just this super fluid, never ending, always changing thing. And I don't really think there's like a black and white way to teach it. So I have come to that realization that the best way that I can teach Forex now is just through experience and through teaching the stuff that I know that works and just making it very repetitive so that you, the viewer, the student, client, sees that over and over again so that you can have success trading Forex. That's what's been working really well for me the past few months. When I started Mission FX 2 years ago, I taught one strategy, and it was a divergent strategy, and it worked pretty well. But there was people who got stopped out of trades all the time. There's people that would see it wrong. There's people that just didn't have trading experience. They didn't have enough experience with price action, and some people didn't even know what price action was. So my goal for making this course right now is to give you a full, complete overview and breakdown of Forex and charts and every little detail that I can find, just to put it in here so that you guys can go through that and go through all this content. It's going to be hours and hours of content, so that you guys just have the best foundation to have a good Forex trading style that you can then incorporate your own emotions and psychology into. Because I promise you, the style of Forex that you trade today will not be exactly the same 1 year from now. And that's just from personal experience, and not just from my own personal experiences, but from personal experiences of a lot of people that I've followed very closely throughout the Forex niche the past few years. So that's so how I'm going to teach it now is I'm just going to go over basics, and we're just going to look at some basic stuff, and I'm going to try to keep it as peaceful and relaxed and simple as possible. And just over the course of the next coming weeks and the coming months, as long as you follow along and you just take the time out of the day, 1 to 2 hours a day, to go over these videos and look at charts and follow along in the group chat, as long as you are very patient, I think that you'll be able to get this very well, and I think that you'll be able to learn to trade, and I think that everything will work out very well for you. But you need to have patience. Okay. So that being said, I'm going to pull up a chart here, and we're going to look at a chart with just price. Okay. Now on this chart, I've drawn some stuff on this chart. Let me see if I have a chart where I haven't drawn much on it. Here's a chart where I haven't drawn much on it. So here's what we're looking for whenever we're looking to trade. I'm going to go through a few basic things. The first basic thing we're going to look for is we're going to be looking at levels. Okay. Levels, I think, are pretty important in Forex and stocks and really any financial market, because it sort of gives an area that you can look at on the chart, and if you look at what price does when it gets to that area, you can have a better understanding of what buyers and sellers are going to do. And if you know what buyers and sellers are going to do, you can enter your trade before they do and then profit off of the move. For example, if you thought that price was going to bounce right in here, and price came down and then it went sideways, and you waited and waited and waited, and for whatever reason you thought price would shoot up from right here, you waited until price got there, you clicked buy in anticipation the market would go up, and the second you click buy, the market over the coming days just shoots up, chops around, shoots up more, and then chops and shoots up more, and you end up making a lot of money just because you thought price would reverse right there because you knew what buyers and sellers were doing. So levels on the chart. Let's look at levels in terms of let's just look at it like as the price of a cup of coffee. Let's say you live in a village in Africa or wherever. I don't know why I said Africa, but let's just say you live in a village somewhere. Let's say a village in the United States, if that's the thing. And the price of coffee goes up from maybe right here to right there. So let's just start it out right here, and price comes up to here. So in your village, whenever you buy coffee, first price started out right here, and let's just call this area, let's say price started out for 1 cup of coffee. Let's make it more reasonable. It costed $1. So price of coffee costed $1 right here And we're just representing this price with a little line chart. This area being price, this area being time. So then after that, price comes down, I'm sorry, price goes up, and then one day, whenever the coffee makers come into town to sell coffee, price goes up to $2 per cup of coffee. And so now, you could buy coffee for $1, now price went up to $2. And let's say that after that happens, price of coffee goes down to maybe the 1.5 mark. So let's say $1.50. So price comes down to $1.50, and then price of coffee, hangs out right there for a while. Then let's say maybe it goes up to $2 again, and then when it gets to $2 again, you have people not want to buy it. And the reason some people may not want to buy it is because if you buy right here, there's going to be some people saying, well, hey, the last time price of coffee was $2, the price went down and it dropped like half. It went down to like let's say just 150 for this example. Maybe that might be up in here or something like that. But just for example, people don't want to buy if they think they're getting a high price. So some of your friends or whatever will tell you, hey man, wait for price of coffee to go down, because it should go down a little bit, at least to 150. And then at 150, that's a good price to buy coffee because it was just there. So then let's say price of coffee, it does this thing at the $2 area, and it comes down to 150 again. And then your friends tell you, hey man, you should buy coffee, bro, because this is it's $1.50 right here. You don't want to miss out. So you might want to buy coffee right there, since price of coffee is now 150, because it's probably going to go back up. And so let's say more people buy coffee right here, and price goes up, and then it does something crazy like this, and price of coffee goes up to, let's just say that that's $3 right there. So this whole idea behind the price of coffee, or the price of this currency pair, which is the British pound Swiss franc, the whole idea behind it is price bounces up and down based on people's emotions, based on people's psychology, based on what people think price will do and how people are reacting to certain prices in the marketplace. If you'll notice, we don't see much reaction to price in this area. Price just kind of goes up and down. But then all of a sudden, when price gets up to here, price aggressively reverses and it comes back down, and then it comes lower, and then we see an aggressive reversal here, and then we see an aggressive move down and an aggressive move here, and then price comes down to here, but there's not a lot of reaction. We see a move here, and then a very aggressive move up, which then turns into a long-term trend. So I want you to look at price on the charts initially, and especially when you first start learning, as levels. And I don't want you to use any indicators. The only indicator I really use is a 14-period RSI, which we'll go over later. But I want you to just look at pure price action, and I want you to get a feel for what price is doing, so that way you can make better trading decisions. And you also, instead of just saying, I think price will drop when it gets to this area, you can say, I know why I think price will drop when it gets to that area, because of what price has done in the past and also what price is currently doing. So in this instance, if price went up to $3 because people bought it $1.50, this is the whole idea behind levels of price. If you draw a horizontal line connecting these two lows, then you will see that price bounced right there and it just went up. So this right here, this little area where price bounces and goes up, people typically call that support in the marketplace. Just an area where price hits and it just goes up. And these are pretty loosely used terms from my experience. Support, and then the other area where price reverses is called resistance. So I'll just type this in here. So that's what this upper area is called, is resistance. You see where price sort of comes up and taps, comes down, it comes and taps again and then reverses. This will be a resistance area. Resistance is like a ceiling, support is like a floor. If you throw a bouncy ball at the ceiling, it's going to bounce off. If you throw a bouncy ball at the floor, it's going to bounce off. Think about price bounces within this levels. And then also, whenever price gets out of a resistance, typically if price is going to continue to the upside, price will come back to this area of resistance, and the previous resistance where price bounced and went down, it will now turn into a support. Price will typically bounce off that area if it's going to be an uptrend, and price will continue to make higher prices. So maybe in this case for a cup of coffee, if people were looking at this and like plotting it as a chart over the course of a few months, they could say price of coffee back in, let's say, January was $1 a cup. In February it went to $2 a cup. In March it was $1.50. In April it went back to $2 a cup. And then in May it went back to $1.50. But then in June, price shot way up to $3 a cup. And it came back just momentarily the next month to $2 before going up to $4 a cup. So now if price is going up and up and up and up and up, you're going to see people want to buy coffee at a low price so they can get coffee at a good price, whether they're buying it to drink or buying it to resell later down the line. They want to get coffee at a low price and they want to sell it at a high price, or just not buy it altogether at a high price. So the whole idea behind trading and how you're making money is you want to do what's called buy at a low price. So I'm just going to put that in here, buy low prices. And whenever you're buying low prices, you buy that because you want to make profit. The opposite of what you can do specifically within the Forex market or any assets that allow you to trade both ways, which is buying and selling, is you sell high prices. So in a sense, in the Forex market, if you think that price right here was going to jump up, you can buy right here. You can click buy. You can enter a buy position. And if you buy a price right here and price goes up, you can close your trade right here with a profit. And then of course if you buy here and price goes down, you're going to lose money on that trade. Essentially the same here as in a cup of coffee in this scenario. If you if price goes up from January to February to $2 and you buy coffee right here, if you look at your bag of coffee that you bought for, let's say, $2, and then you look at the next month in March, from January, February, and March, you would have lost 50 cents on that bag because you bought at a high price, and now the price came down to $1.50, and so now you would lose money. And let's say if you had bigger numbers, if you bought $2,000 worth of coffee, so essentially 1,000 bags of coffee, so you put $2,000 into buying coffee up here thinking it will go higher, but the next month you're looking at a $500 loss because now it only sits at $1,500 for the total value of the coffee you have. And then of course in this case it went up and stuff like that. But the whole idea is that you just want to sell high prices and buy low prices, and that is how you profit off of Forex. Now the same way you can buy right here and make money if price goes up, you can also sell at high prices, meaning you can enter a trade, you can click sell, and whenever you sell, if the price goes down, you'll make money. Conversely, if you sell right here and price goes up, then you will lose money. So consider it this way: if you came to me and said, Nick, I want to make a contract to sell the price of coffee if it goes to $1.50. So if price is $2 and then price comes down to here, and you think that price is going to go down to $1 from here, you can make a contract with me saying, you know what, Nick, I'm going to make a contract with you right now. You and I are going to agree that I can sell coffee to you at any point in the future for $1.50, and then you will give me $1.50 for a cup or a bag of coffee or whatever. Just I have a contract to sell that at $1.50. So I'm going to say, okay, yeah, you can sell coffee to me for $1.50 at any point in the future. So you and me make this contract, and let's say that you have a bag, let's just say for simplicity, you have a bag of coffee, and you have a contract to sell it to me at $1.50. If price goes down, you could sell me the bag of coffee for $1.50, but the bag of coffee only costs $1, so you make a 50-cent profit because the market price will only be $1 here in the next month. But since you had a contract with me to sell it for a higher price of $1.50, I end up losing money because I had a contract with you that I had to buy it at $1.50. I can't buy it from you for $1 because we already agreed that you'd sell it to me for $1.50. So you, just by making that contract to sell at that high price and price goes down, you've profited off of the price going down because you said right here, hey, right here at $1.50, I want to sell the coffee to you at that price. In the future, when price goes to $1, you can still sell it to me for $1.50, making a 50-cent profit. Conversely, if you sell coffee to me at $1.50 and price jumps up, price of coffee is now $2. So now the current market price of the value of coffee is $2, and it comes down, then it goes up to $3. If you choose to get out of the trade right there, or just get rid of your coffee because you think price is just going to go up, you have to get out of this trade eventually. You have to eventually sell your coffee. And even if coffee is valued at $3, which is a very good high price, you only have a contract to sell it to me at $1.50. So if you bought coffee and you made a contract with me to sell it at $1.50, if the price goes up, you're going to lose money because you're only going to be selling it to me for $1.50, but I'm going to be the one making the profit because the current market price of coffee is $3. So if you're selling it to me for $1.50, I'm buying it from you from $1.50, and I get to sell it if I wanted to immediately at $3 per cup of coffee. So the only thing you need to take away from this is you want to sell high prices and you want to buy low prices. Now, how do you know when to buy and sell? That's where the whole concept of Forex comes in, and profiting off of the market movements. And we get these trades, or these indications to trade, to make trading ideas based on this whole idea behind levels. So I'm going to draw in levels right now, and we're going to look at a few levels. Okay, so let's go right here. I'm going to start right here. Okay, so this is where the current market is. So let's just say we're looking at this area up here, and for simplicity, let's just say instead of this being the Great Britain pound versus the value of the Swiss franc, instead of this being an exchange rate or a forex currency pair is oftentimes what it's called, let's just say that this is just coffee. Okay, let's just say we're looking at the price of coffee, and let's say right in here, this price of coffee, let's just say this is like, $50 a bag. Okay, so I'm going to represent the price up here for $50 with this little line. So let's say you were trying to sell your coffee at a good price, and you wanted a contract with me to sell your coffee at a high price because you wanted to make profit off of the price going down. So all the meantime, the past few months, price has been going up and up and up and up and up, and then price of coffee gets to $50 per bag. So let's just say you have one bag, worth $50. Let's say in your village or whatever, let's say that's a lot of money. Let's say $50 US is a ton of money. So price goes up to $50, goes up to maybe 55, but quickly pulls down below, like to 45. So then you start watching. You're like, I wonder what's going to happen. And then price goes up to $50 and quickly drops to like $40. And now you're like, whoa, what the hell? Price of coffee is dropping. And then price goes up again to $50, and then it quickly drops away from $50 and goes down to 45, and then $40 again. And then from the $40 area, price now starts to just kind of dwindle out and go downwards. So what you're going to be thinking in your mind is you're going to be thinking, okay, price of coffee was going up every day that I woke up in the morning. I would hear that the price of coffee was typically higher. Let's just say month to month, going week to week maybe, but month to month for sure. The price of coffee kept going up. But let's say for the past 3 months, let's say this is a 3-month time period, price of coffee stopped going up, and instead it started to move downwards. So right in here, we can represent this little area, this $50 area, as a level on our chart that we just draw. All I did was I took this little line thing here on tradingview.com and I just drew a line. Okay, that's it. That's just a very simple, just drawing a level on the chart. Now price interacts with these levels. As you can see, it interacted right here a little bit, here, and then over here, price touched that level and just dropped. So another level we can look at is, because remember, this can happen from the top side and the bottom side. Just as long as price interacts with a level, we can draw a level there. So looks like price came up here and then went away from it, and then it also bounced right here, and it's also bouncing right here. So let's go ahead and draw this as a level. This looks pretty good. Whenever you're drawing levels, take them with a grain of salt. And you don't have to be stupidly exact. You don't have to be just exact. With this level I drew, you can see price reversed in here and then broke through it. And then it tapped this area, the little candle tail. This just means price went there and then came up real quickly. But this little wick that it left, that just means price went there and jumped up, and all these right here. Same situation with this stuff all in here. The bodies are the big part where price is, and the wicks are when they jump up. And we'll go over more detail about these little technical things later. But I just want you to see this as the big picture of price. Price bounced here, bounced here, bounced here, sort of, but then bounced downwards. Came up and bounced again, bounced, and then continued down. So price frequently interacts with this level. Let's just say that this level right here, where price interacted with so much, let's just say that that is the price of $40, okay? So now you're in your village. Coffee was, once a few months ago $50, maybe 2 months ago, and now price is now $40. So now you're thinking, oh my God, the price of coffee might start to go down. I might want to sell somewhere soon, so that way I can profit. If the price goes down, I'm still going to have a contract to sell for $40 for each bag. Even if the price of coffee goes to $30 or $20, I will have a bag of coffee that I know I can sell because I have a contract with someone who said that they would buy it at $40. So essentially, let's go back. What do we want to do if we're looking to make money off the price going down? We want to sell high prices and buy low prices, okay? So right in here, we would be looking to sell somewhere. And we'd be looking to sell somewhere because we know that the $40 mark in the past, back maybe 6 months before, price kind of played around at that level, and then it bounced at 40, and then it got below $40 and it came up and it kept getting knocked down. Every time price went away from that area, price kept getting knocked down. So let's say you think that price is no longer going to go back to $50, and so you make a contract with someone in your village to sell the price of coffee right here after you see price going down at the $35 per bag of coffee mark. Let's just say that that price is right somewhere. Let's just say right in here. Let's say this is $35. So if you make a contract to sell right there at $35, that means no matter where price goes, whenever you do sell your bag of coffee, which you will at some point, you can sell it for $35. So you make a contract with someone in your village to sell it for that price, and the price of coffee goes down and down and down and down, it drops. And let's say it comes down into here, and I'm just going to draw an area right in here. We're going to look at this in a bit. And we're going to say that this is $20, okay? So this is the $20 mark. I'm going to put it on this side just for the sake of keeping this simple and clear. $20. So let's say price gets down to $20, and then right there you see price start jumping at $20. And every time it gets to there, it starts jumping a little bit. So let's say you see this and you see the prices, every time you go to the market in your village, that all of a sudden for the next few days, prices really started jumping at around $20. And so you're thinking, okay, price might start to go up. If price goes higher, I won't be able to get as much money, because if I sell at $35 and I only have to buy for $20, then I can make a $15 profit per bag of coffee. So I had a contract to sell at $35. Price of coffee is now $20. So I'm gonna sell my coffee right now at $35, and I'm gonna make the $15 profit that's in between. And this just goes opposite for if you're buying. So you can close your trade right here in a sense. In Forex, we just call it closing our trade. But essentially, you're just getting out down here. You're validating your contract. You're putting it into action of selling for this price. Just because you predicted that it would go down, you've made money. Now, the same works for the upside. If for some reason you think price will go up, then let's say you have a level where price has been frequently interacting with. So let's just say a very simple example would be down here, price got rejected hard. Price got rejected hard here, and then it went up a little bit. So let's say this area right here, let's just call it $10 per bag of coffee. Okay, so $10 a bag of coffee. So let's just say in the future, you tell yourself, okay, it doesn't matter when, but if in the future price gets to $10 of coffee, I'm going to buy coffee. So price goes, it comes up, it goes back to 20 again, it goes away from it, and you're like, oh, I'm about to get a good price, and it comes to 11, jumps up to maybe 15, and then comes back to $10 of coffee. If you were waiting to buy coffee at $10, the second you bought coffee, like within the next day, price would have went up to like $15. So now you've made $5 profit, and you're like, wow, that was easy. I can either hold this to see if price will go up more, or I'll just close it, or I'll buy more if it goes back to 10 or whatever. So let's say price, dwindles for a bit. A few days later, it's back to 10. You're like, you know what? The last time price of coffee was 10. The last 3 times it jumped up. So you buy coffee at $10, and then price goes down even more to like maybe $7. So now you're thinking, okay, I've waited a long time for this $10 price. If I can even get $20 for my bags of coffee, I've doubled my money. So if price is going lower to like $7, $8, you're like, wow, that's a deal. So let's say you make another decision to buy coffee in here, and let's just, for the sake of keeping it simple, let's just call this $8. You can buy coffee at $8 anticipating that price might go up, and then right here price starts to go up. So then it comes back to $10, you get pretty happy. Price starts going up again, and then it gets to $15, and then you get happy. So price drops a little here, and then it comes up, and then price gets up to $18. So you're seeing this in the newspaper, you're hearing everyone at the market say, hey, did you hear the price of coffee today and yesterday and stuff? It's up to $18 now. And then all of a sudden it drops like crazy back to $11. And then you see price come here very quickly, and okay, I know price is going to go up to probably around 20 at least. So what I'm going to do is I'm going to buy more. So let's say you buy more coffee right here at $11 because you've been waiting to get good prices. You've gotten bags of coffee for $10. You've gotten prices of coffee for $8, and now you've gotten more bags of coffee for $11. So you're really happy. You've bought more. You got a quick little discount because you thought price would be going up. So you knew the price was probably going to go up, and now you've gotten a big discount, so you buy again. So then price of coffee goes all the way up to here to, what do you know, $20 per bag of coffee. So now you've slightly more than doubled your money across all of the places you bought coffee. So if you bought one bag of coffee for $10, another bag for $8, another bag for $11, in total you've spent what's this, $29. You have spent $29 to buy coffee. If you sell all 3 bags of your coffee for $20 each, you now have made $60 total, or a $31 profit. So you've more than doubled your money just because you got in at low prices. And the reason, the way you did this was because you looked at the price of coffee in the past, made an educated guess that in the future price might bounce up there. And if it bounces, and if you get a good reaction at that price, then you can look to buy that coffee. Okay? So then price goes up, it starts going up, and once price gets to $20, the reason you chose $20 is because in the past, what did price do? Price kept falling every time it got to $20 in the past. So naturally what you're going to think is, you're going to think, okay, $20, since I think the price of coffee might drop, I'm going to sell my coffee at $20. Now remember, we're going to go back just because I want to drill this into you guys. Let's see if we can get it to pop up. This is weird. I'm sorry, I don't know why it's doing this. There we go. Let's see. Okay, essentially, sell high prices, buy low prices. It's not popping up because you guys already know, so that's why it's not popping up, because you guys are already Forex pros for the last 30 minutes. So you thought that price would go up here, so you sold at a high price and you bought at a low price. You bought at a low price, you profited off the price going up, you then sold. And it looks like a lot of other people right here got the idea to sell, because as soon as price got to $20, it dropped to like 15 or 16 bucks, let's say, right there. And so if you had not bought bags of coffee down in here, and you're just someone standing on the sidelines who has a bag of coffee, you can say, you know what, I'm going to make a contract right here with someone to sell bags of coffee at $20. So price comes back up to $20, you make a contract, you shake hands with your friend and say, hey man, I've got this bag of coffee, you can buy it whenever, but I have a contract with you to sell it at $20. So what do you know, price from $20 comes back down because you looked at what happened in the past, made an educated, reasonable guess that you thought it might go down again if it got to that price. So people sold up here, the price of coffee just went down, 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 down. You've already made your profit because you already sold up here if you bought. And then if you're a seller, if you're someone who made a contract to sell, when price goes back to 10 or 15, you can get rid of your coffee, or in a sense close your trade, and then whoever's buying it has to buy it for $10, but you get $20 for it because you had a contract to sell it at 20 bucks. So you can make profit going both ways. Essentially, if you think price is going to go down in Forex, you're going to click the sell button. The trade is going to look something like this. You're going to have an order open, and then the market is going to go down, 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 down. The amount of profits will be based on what's called a lot size and your pips, and essentially how much you're risking, how much you're putting in. But that's just essentially the whole goal, is to buy low and sell high. If you bought in here, the trade would look something like this. It's called a long position, long and short, buy and sell. It's the same thing. Let's say you would have bought at $10 and you would have closed your trade out here at $20. You would have made whatever amount of money it is you put into this. In this case, we put $29 into buying this coffee. We were able to sell that coffee at $20 each, making $60 in total, or a net profit of $31. So it's real simple stuff, just buying low and selling high, and you get to that area based off what price is done before. So a current thing we can look at here is, let me just extend this, and what we're looking at now is current price, and this is where the magic comes into Forex. The magic comes in when you're looking at current price, and you could have been the one to predict when the price of coffee would have gone up or when the price of coffee would have gone down. Because if you can predict either way, you can make money. Okay, so let's say that down in here, we're looking at this area. Remember how we were drawing levels horizontally? Anywhere price was interacting with horizontally, we're drawing a level. Another way you can draw levels is diagonally. Okay, so if you draw a level diagonally, it typically represents a trend. Now, in this area right here, the market was going down. We can draw a level on the top, connecting all of the tops, and then we can pretty much essentially show a downtrend. Okay. Now this one wasn't the cleanest one. Let's look at something a little bit cleaner. We have this area right here. Remember, they don't have to be perfect, but they just have to make sense. Like, price has to make sense. Whenever it hits that level, it essentially jumps up. You'll see that some of these wicks cut through this little level I've drawn diagonally. But essentially every time price gets there, it quickly just goes up. So these diagonal lines, they're just called trend lines, okay? So whenever you draw any level that is diagonal, it's just called a trend line, meaning that the market's just trending. If the market's trending upward or it's trending downward, if it's not trending, then the market's just flat. It's just going sideways. But that right there, friends, is called a trend line, okay? So the trend line can happen upwards, or the trend line can also happen downwards. Typically, you just want to see price interact with a diagonal level at least 3 times. Right here is a really good area. We can see that price interacted here, and then here. Not so much here, but here interacted. We had a quick pullback away before price went up, and then what happens after it breaks out of a level? It typically retests that level and continues the other direction. The same sort of thing happened here. Price bounced here, 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 so that's like 3 little taps. That's typically a good area to draw a trend line. You typically want to get at least 3 taps before you draw what you would call a trend line. Then we got a 4th tap. We had a small reaction right here, but then price broke below, came up and tested that on the bottom, and then came downwards. So just like we drew support and resistance areas, resistance being the ceiling, I'm just going to draw that with RES. Okay, so resistance right here, it's just every time price is interacting, this is just a resistance area. And then a support area would be like this $10 mark, because price, every time it gets to that area, it bounces. I'm just going to draw this with SUP, signaling support. Or you can just say sup. Sup, how's it going? Sup, support. So that being said, a trend line acts the same way. Whenever price bounces it, you can consider this a support, because when it hits it, it goes up. Some people will call this an ascending support, and some people will call a downward trend line like a descending resistance, but you don't have to know all that. All you have to know is that any line you draw on the charts connecting price data is just levels. They can be slanted, they can be diagonal, they can be horizontal. I've never seen this before, but they can probably be vertical, but I don't know how you how you do that. But essentially any area you draw price interacts with, it's just a level. So this level is just slanting upwards, but price will do the same thing. It'll bounce. It'll typically break that level and test it before continuing in the other direction. Okay, so let's make a speculation as to where we think price could go in the future. Let's just scroll out to the bigger picture. We can see right in here, if we're looking at a scale of monthly basis, this would have been years ago. Price came down into here, all the way over here, and price looks like it started interacting with a level over here. Okay, so we've seen that happen. Now we've seen price come to the same level and bounce. So I'm going to go to a higher time frame, which is a daily chart, meaning each candle on the chart represents an entire day worth of price action. And what we see right here is we see price bounce off this level a little bit. And what's really interesting is price bounced off that level right there. It also bounced right here. It went through it, but then it went right back up. So yeah, price went below it, but essentially it popped right back in. It's still a valid level. Price respected this level right here and right here. It looks like it respected this level to the downside in there, and then to the upside in here. We had a little bounce right there. So just all in all, this looks like a very well respected level, and now price is at this level again. So my question to you is, what do you think is going to happen from here? If you thought that price was going to someday be up here, near the $20 mark for coffee, if this is coffee, if we're just saying that, you could extend this level and say, you know what, I think when price gets to $20 per cup of coffee, we might see price drop. And you can also say right here, price of coffee may be, this may be what we can call it like $5 now. You can say, hey, right here, we think the price of coffee is at $5. This is a steeply discounted price. If we're going to be in this trade long term, or if we're just going to have patience and wait, we think that ultimately price could go up here to $20 and we could make 4 times our money just off this one quote-unquote trade, just off this one decision to buy here at what we think is a low price and then to sell up here at what we think is a high price. So just because price bounced off that level right there means that, hey, we may start seeing price sort of change direction. And then another thing, if we're drawing a level going downwards, right, and we see price respecting this level going downwards, if we see price break out of this level and then come back and retest it, now we have 2 reasons to think that price may continue going upwards, because we were in previously a downtrend where prices just kept going down, down, down. And then all of a sudden, if price gets out of that to the upside and then comes back and tests it and starts going up even more, you now have 2 reasons to think price will go up. The first reason will be because if price breaks out of this downwards level, this trend line, it typically means that a new trend will form as long as price can hold outside of that trend line. If price just goes up real quick and comes back right back in, then typically means price will continue downward. But if price gets out of that trend line and holds in that area, maybe like tests this trend line right here and continues up, this is typically a good sign that price should go up. So if you combine that mentality of a broken downtrend that could signal the beginning of a new uptrend, if you combine that with what you did on the higher time frames, like the daily chart, in a sense, looking at the cup of coffee over a long period of time, you could say way back in the past, price of coffee has historically interacted with this $5 per bag of coffee level. So I think that it's going to go up because it's bouncing right there. In addition to that, if it breaks that trend and comes and tests the top of that downtrend, this could potentially be a new uptrend forming, and you can make so much money just off of identifying trends in the marketplace if you think the price will go up. So guys, I hope I didn't cover too much. Right now we're sitting at about 39 minutes worth of video content. I just wanted to introduce you guys to levels so that you can understand what levels are in trading. Because levels in any type of trade, whether it's a new toy you're buying for one of your kids or for someone's present or something, or whether it's a cup of coffee at the coffee shop, whether it's gasoline, the prices of gasoline fluctuate to the point sometimes where people will literally buy tankers full of gasoline if it's at a low enough price because they're afraid price is going to go back up. I've heard stories here in Texas where some people would buy like a tank full of gasoline, like a huge tanker truck full of gasoline when it went to $1 per gallon of gas, and they would just put a bunch of fuel stabilizer in that tanker truck full of gasoline to keep the fuel fresh and keep it from going bad, and they would just buy tons of oil and gasoline at $1 per gallon, and then when price would go up to $2 and $3 and $4, they wouldn't be buying it just because they bought at a low price, and they were able to use that product, which is gasoline, by getting it at a low price. People like to buy at low prices and they like to sell at high prices. Or, I've heard of this too. People will buy gasoline at that price and then they'll sell it in bulk once price gets up to $2 or $3 per gallon to people who are willing to pay that much. So let's say you bought, $10,000 worth of gasoline in a huge tanker truck, or 5,000 or whatever, you know what I mean? Let's just use $1,000 for a good example. Let's say you bought 1,000 gallons or you bought $1,000 of gasoline at $1 per gallon. And then a few months later, the price of gasoline went up to $3. You could sell that gasoline. If you sold it all, you would make $3,000 in total off of selling all that gasoline, but you only had to buy the gas for $1,000. So if you subtract that out, that leaves you with a $2,000 profit. So it is a very, very lucrative and very good skill to have to be able to predict trends in any marketplace, because it allows you to make money and capitalize on what trends are. Okay, so this, like I said, this first video was just to introduce you to price, just so you know what you're looking at when you're looking at price, and you know that it's not just these candles on a screen of you marking up with all these different indicators and all these different tools on your chart. It's just so you can look at this chart and be peaceful and just look at the price and what it's doing, and look at what people are doing whenever price interacts with certain levels on the chart, or levels, in essence, certain prices on the chart. It's the same thing. And I just want you to understand why the market moves. The market moves because because of people in the marketplace. Okay, people in the marketplace, what they're doing when prices get to certain levels, what their emotions are telling them to do, how price is reacting to certain levels, and where you should place trades and things like that. So I hope you guys learned a little bit about levels today. We're going to go into a lot more detail in the future videos. I just wanted to introduce you to price, okay? Price levels and stuff like that. So this has been a video here with Nick here at Mission FX, and I will see you guys in the next video. Bye.